Good morning, Adam. Thanks
Morning.
for coming. First, I must say congratulations for Fiverr. It was an exciting moment, I think, for you. 12 years on the road, right? You were the first investor in institutional, I think.
That's right. We were the first institutional
investor for Fiverr. Can you tell me first a bit your feelings pre the IPO roller coaster, up, down, and second, why don't we see? We celebrate so much this IPO because we don't see enough of it. There are none. If you can look back, there are none. There are not so many, or at all IPOs, feasibility companies, which in the past were like, the number 2 in NASDAQ and
right.
This.
Okay. Well, obviously, I'm super excited and happy for the IPO of Fiverr. From our perspective, it's not an exit; it's a financing event. Of course, after 8-9 years, it's a very important milestone. I'm particularly happy because it means the company's matured to a point that it can IPO, and that's kind of leads to the second question, which is why we haven't seen more IPOs coming out of Israel. I think you need several things for an IPO. The first is the top line number. These days, it's approaching a kind of a $100 million revenue run rate. Of course, that assumes relatively high margins, meaning if you're selling underwear online, you're selling $100 million at 15% margin, that's not going to work. The second thing is a growth rate of, let's call it 30% and above, so that investors can really buy into your future. And the third thing is predictability, meaning you understand your business well enough to keep that growth rate and to actually anticipate it so that you can give some kind of guidance and be comfortable with. A lot of companies don't have one of those three. There's probably a fourth factor, which is the management team, the depth of the management team, and whether they can handle the immense cost of being a public company. It's incredibly expensive.
It's not also about what I call guts to be.
Well,
look,
look,
the guts to go out and be a public company and not wait for the
a lot of it depends
on being acquired.
A lot of it depends on the CEO and whether the CEO is willing to stand in front of the public and make commitments and make claims and back them up every single time. That's not for everybody. When a founder starts a company, most founders are not thinking about being a public company. It may be some part of their dream, but it's not the main part of the dream. Success is the main part of the dream. Perhaps wealth.
Exit.
But again, IPO is a financing event on the path. You could be public for the next 20 years. There are some companies, Israeli companies, that are now being public, for 3 times the amount of time that they were private. We forget that. So it does take guts. In this age also of growth financing, when it's so easy, and much easier, I would say, to raise money from private markets at very healthy valuations, it's also very tempting to stay private. So it does take a certain amount of guts. Time will tell who's right, but I do anticipate that over the next 3 years, we'll see about 10 Israeli companies going public. I think the industry is maturing. A lot of these companies are SaaS companies or recurring revenue companies where predictability is built into the model. And so I'm quite optimistic that we'll, 3 years from now, if we're sitting here, we'll be talking about the last 10 IPOs.
Okay, you're very optimistic, I must say. Let's talk about a bit the huge war that is above the high-tech scene, China. There is a huge trade war between China and US, and the high-tech at all, like we've seen Huawei's case and other cases, is stuck in the middle. It's not really the problem of the high-tech, but something. What do you think Israeli startups and VCs should do now? Do you, and I know you spoke about it before, should be involved in any VC from China, money from China, or no?
So I do have a perspective on China. I am one of the few VCs in Israel who lived in China for a period of time. I lived there in 2003, and I did develop certain views based on my experience there. In our Israel-centric world, we're not the only one caught in the middle. Every other country is also caught in the middle between the US and China. Much bigger countries like India or the UK or Germany. Our perspective obviously is from a VC and startup and high tech, and it's true. We've often viewed China as kind of a critical market for Israeli high tech. I think that's been a story we've told ourselves the last 15 years. I think it's a story we'll tell ourselves for the next 15 years because we can't avoid that huge, enormous market there. Eventually, we will see the impact, but I actually don't see that impact right now. The impact that China is really having on Israeli high tech right now is primarily financing. It's not as a market. I'm not familiar with Israeli startups that their biggest market is China. And if they are, they're pretty small startups. That may change. But right now, we don't really have those test cases. So with regards to Chinese money, we probably should divide the world into Chinese financial VCs and Chinese strategic. Right now, I'll agree they're both somewhat toxic because of the trade war. I think the trade war will end. I think that they want a deal. I think it's in their mutual interest. But you don't know when. And so I would urge all companies to be extremely cautious. In the US, it's pretty much on lockdown from a Chinese money perspective. I think Israel's not quite there. But I advise my own companies not to take it. And that's also tempting because it usually these are usually investors who are not as experienced, who haven't seen the same kind of deal flow that we see, let alone American VCs see. So they will pay higher prices, they'll invest larger sums, and it may seem easier capital. But I think it comes with certain strings attached that you'll only find out several years down the road. So I think for now, we have to be cautious.
We spoke a little bit earlier about growth and profitability and efficiency. We feel a bit that we are some kind of a huge bubble. Everybody is not talking about it or talking about it because there is, as you said, a lot of money out there. Not something that we didn't predict as a SoftBank vision with the $100 billion, which changed the whole system. Do you believe we are some kind of stage in a bubble, or because companies like Uber, which has lost huge loss, we're now in isn't not like another bubble, but the profitability bubble, the let's spend a lot of money, VC money because we have it?
Yeah, I'm not going to claim we're in a bubble. I do think we're in an environment where financing is relatively easy, with very low interest rates for just a long time, and capital coming from new sources that have never really been available to startups. It makes for easy financing, and that doesn't mean that only that every company is getting financed, but they're raising larger rounds than they ever have at higher valuations than they ever have. So within that environment, there are going to be a lot of companies that are overvalued and are, you can call them kind of micro bubbles. Those companies probably aren't worth.
Sorry.
Please, everybody, turn off their cell phones. It's easy to point fingers at one particular company and their losses. Those are companies that belong to a different breed of company, that this blitz scaling kind of companies where losses are not an issue as long as they can continue triple-digit growth rates. Maintaining kind of triple-digit growth rates over an extended period of time is a new phenomenon. And in fact, in Israel, there are only a handful of companies have ever managed it. In fact, I haven't been involved in companies that have maintained triple-digit growth rates for more than 3 years. In the US, we have companies that are doing it for 5, 6 years and are still predicting it going forward. That incurs incredible losses that need to be funded from somewhere. Time will tell whether that's a bubble. I think some of these companies definitely are worth what they're trading at. Because they're either generating cash or they really own their market and they have no competition. Others, I think, will be surprised to find that that time or scale does not yield profits, that it's just a never-ending kind of treadmill, that as big as they get, they're just losing more or they're losing the same amount. And then we'll look back and say, you see, we were in a bubble. But at the same time, I don't think it's a bubble we saw in the past, because there are companies.
It's never the same. It's a new one.
It's a new, no, but in the sense that there are some incredibly profitable, fast-growing companies, the likes of which we've never, ever seen. Even if I go back to the year 2000. I mean, there are, and it's not just one or two, I'm talking about dozens of companies that are really animals that we've never seen before and will be, take Zoom, for instance, or...
But this huge amounts of money creates a huge problem for you, VCs.
Absolutely.
Exiting in these times is very difficult, especially, let's say, for you, when you don't like a $100 million exit, which I think most of the VCs, and most of the VCs now sell their shares to private equities or secondaries. Suddenly we see a lot.
No, not most. That's
a lot. We see a lot. We saw a lot of it occurring lately. selling their parts, selling some part of their equities to Insight is buying everything on the road lately. So what's going on to be? Because you can't see an exit, you can't sell yourself, you can't make an
Right, so that's a downside of raising a lot of capital at high valuations, or valuations that really don't make sense, or valuations that you're not sure you can grow into. It's a danger. I mean, that's one of the messages I give to all my companies. I don't want to be part of a company that's, I think, has raised money at too high a valuation. Sometimes I feel uncomfortable, but and sometimes I'm proven wrong that actually it was the right valuation and I was being too conservative. It's a risk, and at a certain point you'll find that you may be unable to exit in traditional ways. And yes, VCs will find their way out via private equity or other ways. I don't think that's not mainstream, though. There may be some high-profile ones here, but that's not mainstream. We may have done that in 2 or 3 cases over the last 4 years, and that's
DriveNet. It's $100+ million.
No. That's an investment. That's not. I'm talking about exits. What are you talking about?
A huge investment like DriveNet.
Oh, large investments?
Yes, it's going. There.
If a company needs the capital, that has nothing to do with bubble. You're talking about valuations. I don't think the sums of investment really tell you anything. Companies that need the capital and can justify it based on growth plans, they deserve whatever they get. I mean, at times the rounds are slightly bigger than maybe the company needs. We do see companies, when I ask them, why are you raising 50? They say, because we can. That's not always the answer I like to hear, especially when they really only need 10, or when they're already profitable and they're raising 50. But you know, when we see that, it's also a sign that they also are somewhat fearful of the future. They're also thinking, well, what happens if the market turns? And maybe it will. So I think what you have now also are a lot of companies that can raise capital, raising it for a rainy day. And then, by the way, when the proverbial bubble bursts, it will take a long time to sort itself out, because there will be so many companies that actually never needed capital or have sufficient capital.
One final question. Do you think this rainy day is close? Or you don't see it in
I cannot predict. I've you know, for 5 or 6 years, I've been saying, you know, the end is nigh, but it's not. It's you know, there is an end. I cannot tell you when it's going to happen. I think everybody needs to be conscious of the fact that there will be an end. I'm not sure it will be an explosion. It may just be a slow degradation in the multiples, and there may be some capital sources drying up, like from China, or you know, all of a sudden Saudi Arabia pulls the plug on the Vision Fund. I don't know. You know, anything can have somewhat of a negative effect. I don't think, though, overnight capital will dry up unless there's some other macro crisis going on. You know, the funds that have raised capital, those are sufficient funds for years to fund their own not for all startups, but for the best startups, easily to continue for years ahead. Which is why when we're part of this, you know, we're a well-endowed fund where we have a lot of capital, we're not as worried when we think the fundamentals of the company are strong. The companies that we worry most about are those that lose so much money and their losses are only growing. And I don't mean losses from a GAAP perspective. I mean cash losses. Those are the ones we're more wary of.
Okay. Thank you very much, Adam. Pleasure having you.